Australian inflation showed a taming today, rising less than forecast at 0.5% for the first quarter and 2.6% for the year. I've got CBA's Peter Dragicevich on the line now with all the latest. Peter, thank you for joining us. Firstly, can you walk us through the fundamentals behind this figure?
Well, the Q1 CPI data did surprise not only us but majority of the market. The biggest surprise or downward surprise that came through was a smaller than expected rise in food and the housing categories. There was also some of the seasonal factors were lower than expected. So they were the main drivers behind the slightly lower than expected CPI. But nevertheless, headline inflation in Australia is still running at just under 3%. It was 2.9% in the first quarter, and the underlying measures of inflation, which strip out the more volatile items, are still tracking at 2.7% per annum, and that's just a little bit higher than the midpoint of the RBA's 2 to 3% target band.
The updated inflation figure will end speculation that the RBA is set to follow neighbouring central bank, the RBNZ, in hiking rates. What comparisons are there to be drawn between the inflation picture in Australia and New Zealand ahead of the RBNZ meeting on this Thursday?
We think the inflation picture in the two economies is slightly different. From the Australian perspective, we do think there are a lot of structural inflationary pressures still in the economy. Domestic inflation up until the first quarter had been running at an annualised rate of somewhere between 3.5% to 4% over recent quarters. It did drop down to 3.1% in the first quarter. But that's still on the higher side of the RBA's band. So it's really been the imported inflation or deflation over the last few years that's helped keep total inflation in check. So those structural pressures are still there, and we still think they'll remain in place over the coming year. In terms of New Zealand, it's slightly different. They're at a different point in the economic cycle. They've got a very big construction boom that's just taking place with the rebuild of Christchurch. So as growth in demand is picking up and it's absorbing all the spare capacity in the economy, that's really driving the inflationary pressures or the outlook for higher inflation in New Zealand. So that's what's driving the RBNZ to tighten policy, and we expect them to follow their recent rate hike with another one tomorrow.
The RBA have done little to acknowledge rising inflationary pressures within the Australian economy. Will they be breathing a sigh of relief today, or is inflation still expected to exceed the central bank's comfort zone?
Well, the Q4 2013 CPI data did surprise not only us but the RBA. They spent a lot of time discussing possible reasons for that. I think the pullback that we saw in Q1 will should see the RBA have a sigh of relief. So underlying inflation is within the target band. We have had the currency pick up in the first quarter, so that should put a bit of a dampening spin on imported inflation. So that should just keep overall inflationary pressures in check over the coming quarters. But as I mentioned earlier, we still think there's a lot of structural inflationary pressures still at play in the domestic economy, and we haven't really had that inflation transition that probably the RBA is looking for just as yet. So we're still expecting those inflationary pressures to remain in play towards the back end of this year, and that's why we've still got an RBA rate hike penciled in for the final quarter of 2014.
What does today's prices outlook suggest for Aussie dollar performance?
Well, we did see the Aussie underperform quite sharply today on the back of the CPI data. It fell a full cent against the US dollar. In our view, it doesn't really change the fundamental picture. Domestically, the transition away from mining investment-led growth to the other areas or other drivers of growth in the economy is coming through. Leading indicators for the labour market have picked up, and that suggests employment growth should pick up over the coming 6 months. So arguably the unemployment rate is close to, or if it hasn't already peaked. And on the back of that, we have seen the RBA move to a clear neutral bias. So we still think, well, the next move by the RBA, barring an unexpected event offshore or domestically, we think the next move by the RBA will be a rate hike. So those fundamental drivers are still firmly in place despite today's CPI disappointment. So we still expect the Aussie dollar to remain pretty well supported and to grind up over the course of this year.
Peter, many thanks. That's all from me. Goodbye for now.